Hey, Smarty Pants. Your student loans may be the first time you ever acquire debt as an adult, and thus may be the first time you get to say, "What do you mean almost half my payment is only going to interest?" Which may send you down a super not so fun spiral of financial worry and really take the shine off those loans that you signed when you were deemed too young and irresponsible to have a drink, but not too young to take out tens of thousands of dollars in loans. Huh. Once you understand how student loan interest works, which isn't that hard. I mean, if you got through college, you can get through this. Even if you didn't finish through college, you can get through this. You've absolutely got this. You are going to feel like you've been given the absolute keys to the kingdom. And honestly, when I learned to calculate this stuff, I just felt so much better about my loans. Like they were something I could control rather than feeling like they control me. It really made me feel so much better about my student loans, and I want to do that for you. Because most people don't understand how interest works, so you just end up stressed out looking at your student loan bill and you feel like you don't have any power. You feel like you're just losing money. Luckily, when you are able to understand how student loan interest works, you can use that knowledge to either come to peace with paying the loan because you know with each payment you'll be making more and more of your payment towards the principal, or you can maximize your payments by crafting a strategy so you are paying less in interest overall. If understanding financial math were easy, because it's one of those things that's simple but not easy, you would know it by now. So let me, Kate Moody, your friendly, financially savvy money librarian, explain to you how student loan interest works so you can stop stressing about the cost of your loans and make an informed decision as to whether you want to pay them down. Share this with a friend who may be feeling a little bit overwhelmed with their student loans. Student loan interest is not the sexiest of subjects, but do watch through to the end because you'll feel empowered, like you just learned a secret power that is guiding your entire life. Because honestly, you're going to get a peek into the world of money financing, which is an invisible hand, if you will, that can either push or pull you for the rest of your life. This is educational and informational. I am not giving advice. Don't blame me when you start feeling super smart about money. Wait, let's get on the same page so that we all know what I'm talking about. There are 3 terms that people often use but maybe can't define, and if you don't know what these are, you're going to be pretty lost during this video. These are the terms you're going to be seeing over and over and over again anytime you're borrowing money, so it's really important for the rest of your life to understand them. Principal is the money borrowed. So in the example I'm going to be using in this video, it's $50,000 as the principal student loan debt. The principal will get knocked down every single time you make a payment. Of course, lenders aren't lending money out of the goodness of their hearts. They expect to be paid for lending you money. Interest is the cost of borrowing money. It is often expressed as a percentage of the money borrowed. And now my cat needs to come into the office and says hi. That is the reason why I have so much cat fur on my clothes. Now, where was I? It makes sense that interest, rather than being a flat fee of like $50, is a percentage of the money borrowed. That way it's always in proportion to the amount of money borrowed. So if you get $100 at 5% interest, that's going to cost you $5. Borrow $1,000, that's going to cost you $50. Borrow $10,000, that's going to cost you $500. You get the point. Federal student loans have a fixed rate of interest, meaning they don't ever change. The rate you signed for is the rate you'll have for however long it takes you to repay, unless you consolidate or refinance, but that is a video for another day. And the last term is balance. Balance is the current total amount that you'll have to pay back over the life of the loan. Every time they add on interest, it makes your balance go up. But then you make a payment, which makes your balance go down. The balance consists of the principal plus the interest plus any fees or dues or other things that may have increased it or decreased it. When you make a payment, they take off the interest, and then any money left over from your payment goes to reducing that principal. Get my student loan forgiveness cheat sheet, which gives you the lowdown on 13 different federal student loan forgiveness programs, link in the description. Now that we're on the same page with terms, let's get into how student loan interest is calculated. In my example, we have a $50,000 balance at 6.5% yearly interest, but you pay monthly, and depending on the number of days in the month, more or less interest will accrue. Accrue just means add on. So what they do, they take the balance at the beginning of the month and ask themselves, what is 1 day's worth of interest on this? Remember, if 6.5% is the yearly interest, then 6.5% divided by 365 days is the daily interest. In my example, take 6.5% divided by 365. And of course, 6.5% means out of 100. So when we do the division, you have to move that decimal point over. 0.065 divided by 365 equals 0.000178082. The daily interest on $50,000 is $8.90. All I did is multiply 50,000 times 0.000178082, and I didn't hand draw this out myself. I typed it into my phone and my phone came up with the answer. Now, if it were January, which has 31 days, you'd multiply the daily interest times 31. So $8.90 times 31 is $276.03. But if it was February, and most Februaries only have 28 days, you'd multiply $8.90 times 28 equals $249.31. That's the number they add onto your balance at the end of the cycle. That is the interest that accrued during that particular month. Are we having fun yet? I actually am, because I really love financial math. And honestly, when I learned to calculate this stuff, I just felt so much better about my loans. Like they were something I could control rather than feeling like they control me. This is like 4th grade math, so you've totally got this. Okay, this is the formula that they use. The outstanding principal balance times the interest rate divided by 365 times the number of days since the last payment. We just went through this all, right? Let's look at the one that I just showed you. Outstanding principal balance, 50,000 times interest rate divided by 365. So that was 0.065 divided by 365 times number of days. So again, if it was January, it was 31, or if it was February, it was 28. Easy peasy. You probably have a phone that you can do this on. You can type it into Google. You could use a Google Sheet. You don't have to handwrite this stuff out. So let's bring it all together and see how interest works over the life of your student loans. If you're on the standard plan, you have the same payment every single month. At the beginning of the loan, because the balance is the highest it should ever be, the amount of your payment that goes to the interest will also be the highest it will ever be. The only thing that changes in this formula will be your balance. As your balance goes down, but your payment stays the same, more and more of your payment is going to be going to the principal and less of it to the interest. I am very proud of this chart because it took me way too long to make it, but it's really good at illustrating how much of your student loan payment is going to interest, shown in red, and how much of your payment is going to the principal, shown in blue. The x-axis just shows you the 10 years of repayments. Every single month sending in $567, you can see a whole lot, almost half of the payment in January 1st, 2024 is going just to interest. But then you get to like halfway through, round about mid-2029, and now it's more like 25% is going to interest. And then by the end of the loan, almost none of it is going to interest. It's all going to the balance. Now, there is a huge caveat here. If you are on an IDR plan other than SAVE, it is possible that your payment doesn't even cover the interest, so your loan balance can actually go up even though you're making payments. With SAVE, the government will kick in the rest of the interest so that your balance will never go up. But on the other income-driven payment plans, if your payment does not cover the interest, whatever interest you don't pay off every single month will be added on to the balance. So it is totally possible to be on one of the income-driven repayment plans other than SAVE and be paying every single month, and for your loan balance to actually be going up. Be very careful about that. That has burned a lot of people. It is what we in the industry who don't want to get on YouTube's naughty list call CalPoopy. Here is how you can calculate how much of your student loan payment is going to interest every single month. This is only for federal student loans, not private student loans. Private student loans accrue interest differently than federal student loans, and I will tell you, not in a way that benefits you. First off, figure out what is the daily interest rate. You are going to divide your interest rate by 365. And remember, if you have like a 5.5% interest rate, that is, you've got to move the decimal point whoop, whoop, over 2 spaces. So you would type in 0.055 divided by 365 to find out what the daily interest rate is. Once you find out what the daily interest rate is, multiply that times the balance. For example, if you had $80,000 balance, you multiply that times the daily interest rate, which is 0.00015,068, and you get $12.05 of interest per day. And then you will multiply that by the number of days since your last payment. For example, the daily interest is $12.05. Multiply that times 31 for the number of days in the month, and you will get roundabout $373.55 for that month's interest. If you want to pay down your student loans fast and smart, be sure to watch my other video where I show you 3 scenarios to take thousands of dollars off interest, and more interestingly, why you may not want to. I realize financial math isn't everybody's cup of tea, but you guys, you are awesome. Good job following through, watching this video. It really will make you feel a lot better about your student loans, make you feel more confident and in control of your money because you understand how the interest is accruing. I've got a link to the federal government's explanation of student loan interest if you want to learn more. Let me know in the comments if you found this useful or if you'd like a downloadable spreadsheet or something to help you with your student loans and what features you would like to see in that spreadsheet. Cheers!